Hello everyone, my name is Anjani Kumar Khetan. I am based out of Bangalore, and in this video we will continue our discussion which we started last week, and now we will cover that if a financial guarantee is issued within the group, so if there is an intra-group guarantee, how the accounting has to happen. Okay, so this will be a continuation of our previous video of last week. Now, if you look at, this is what we discussed in the last week's video, where we discussed about a scenario where the guarantee is issued by a third party. But what happens in scenario wherein the guarantee is issued, let us say, within the group? Let us say a parent of a group issues a guarantee, say, in favor of the subsidiary. Now, the question is, in that scenario, how do we deal with such guarantee which is issued by the one entity within the group in favor of another entity in the same group? So let's take a simple example to illustrate the situation. Let us say you have a company, City Corp. City Corp is the parent. This is the parent. It has its subsidiary ABSPL, and this ABSPL needs some kind of funding, let's say a bank loan. Now, this ABSPL reaches to a bank and it asks for that, okay, if I were to take the loan, what is the interest rate at which I can get it? Let's say if it is $10 million. Now, bank says, considering your credit profile, the loan can be given at 11% without any guarantee from your parent entity. The bank also says, in case you are able to provide the guarantee of your parent, thereby meaning that tomorrow if you default on the loan, then in that case, your parent will make good the losses which I incur because of your default. And if that be the case, that if you are able to get me the guarantee from your parent, then interest rate I will reduce from 11% to 8%. Now the question is, in these scenarios where the subsidiary is getting the benefit of the reduced interest rate because of the guarantee given by the parent, City Corp in this example, how the parent should account for such a transaction. This is exactly what we are going to illustrate next in our next few slides. Let's move forward. So, if you recollect, in the previous video last week we mentioned that issued financial guarantee contracts are initially required to be measured at fair value. So the principle remains the same even in this case as well. The challenge which comes is that unlike when you have the third party guarantee, now in third party guarantee, generally the third party obviously will ask for some premium. But when the guarantee is being issued within the group, even when it is intra-group, generally these are issued without any charge. So the challenging piece would be, how do you derive the fair value of such guarantee in which the group entity has not charged any particular fee? Now, this is a really daunting and challenging task, and more importantly, because there are no specific guidance which are available under the Ind AS 109 or IFRS 9. It just references to say that it should be at fair value. Now, if you would know that generally fair value would be measured, okay, under Ind AS in the standard Ind AS 113. Now, corresponding to IFRS, you have IFRS 13, which also deals with the same topic, fair value measurement. So, the generic requirement for measuring fair value is given in the specific literature dealing with fair value measurement, which happens to be Ind AS 113 in the Ind AS perspective and IFRS 13 from a IFRS perspective. Now, the moot point which we are trying to say that if the issue of the guarantee is within the group, it poses a difficult issue in terms of how to derive the fair value. And Because there is no specific guidance, generally this fair value would be measured by applying the principles given in the fair value standard, fair value measurement standard, which is IFRS 13 or Ind AS 113, depending upon which framework you are looking at. Now, if you look at the third point, this is the generic principle given under the fair value measurement standard. Now, this standard tells you that a fair value measurement, it would require an entity when you are measuring the fair value to consider all of those assumptions which the independent market participants, the buyers and sellers in the market, who are acting in their best economic interest, what presumptions, what assumptions they will take when pricing a particular asset or liability. Now, in this case, you are issuing a financial liability. Now, the moot point is that if this kind of a financial guarantee would have been provided by third party, what is it that they would have asked for? That is the kind of the number which you have to look at to arrive at the fair value. And that's what the fourth point says, that if the financial guarantee contract was issued, if this would have been issued to an unrelated party, not within the group, on a standalone arm's length basis, like what we saw in the previous video last week, then in that case, fair value will generally be likely equal to the premium amount which you have received for issuing such a guarantee, unless there are evidences to the contrary. In general, the premium which you charge as the issuer of financial guarantee to the counterparty, that would be the fair value of the guarantee. Right? So this is the sum and substance of this particular requirement, wherein the requirement is that you have to look at what would have been the fair value if you apply the concepts of Ind AS 113. Now, considering that it creates some of the practical challenges, the ITFG, the body which is formed by ICAI in connection with facilitating the implementation of Ind AS in India, they looked at this particular aspect, how to arrive at the fair value of such financial guarantee which is issued within the group. Now, they, in their bulletin number 16, this ITFG in bulletin number 16 have looked at this issue and have given three potential manner in which the fair value of the guarantee can be determined. What are these three? If you look at the first one is that ITFG has given the guidance that if you have a scenario of intra-group guarantees which is being issued, you can look at the present value. One possible way is to look at the present value of the amount by which the interest, the cash flows related to the interest in respect of that loan is lower compared to what it would have been if the loan would have been without a guarantee. Now, if this example which I started with, that without guarantee interest rate is 11% and with guarantee 8%. Now, this principle says that the delta of these two, the 3% differential of interest rate is the interest saving, which this entity will gain if the loan which they are taking from the bank, that loan is with guarantee. So this approach says the present value of that interest saving to the extent of 3% for the tenure of the loan, that is one way in which you can determine what is the fair value of the guarantee given by the parent. The other alternative which they said, that other possible approach would be the amount that an unrelated independent third party would have charged for giving this kind of a guarantee. Now, of course, this is similar to what we have seen in the last week's video. It's like saying that if the third party would have given guarantee on behalf of this ABSPL for the loan taken from this bank, what that third party would have charged, that is the amount which can be considered as the fair value of the guarantee given. And the third approach which they said is the present value. The ITFG gave guidance, present value of the probability weighted cash flows that may arise under the guarantee. That is thereby meaning if I as a parent has given a guarantee to the bank the likelihood of this subsidiary making a default, and because of that default, what is the probability weighted scenario, how much which I am expected to make good the losses to the holder of the guarantee, which is the bank. Now, so these are the three possible scenarios, which is something with the ITFG, the Ind AS implementation facilitation group, that ITFG formed by ICAI in bulletin number 16, they have given this guidance. And this is something which we will illustrate by way of a particular case study on the subsequent slides. So let's say by way of a case study, we will continue similar example which we said, 11% interest rate without the guarantee and 11% with guarantee. So let's continue that and see here that ABSPL, which is the subsidiary company, is a 100% owned subsidiary of this parent City Corp, and the parent, this guy, has a relatively stronger credit rating vis-a-vis the subsidiary ABSPL. Now, ABSPL, this subsidiary requires funding from the bank to the extent of 1 million rupees for a 3-year period. And as I said, 11% is the interest rate if no guarantee is given by the parent, but with the guarantee from the parent, interest rate gets reduced from 11% to 8%. That is 3% saving in the interest. Now, as of 1st of April 2021, ABSPL, this guy, actually opts to borrow at 8%. That means they convinced City Corp to give the guarantee, and because of which the bank agreed to provide the loan on 1st April 2021, post taking the guarantee at 8%. Now, for this giving the guarantee, the parent does not charge any amount, any fee to the subsidiary. Right? This is the fact pattern in this particular case study. Now, continuing the facts of the case study, it is given that 1 year later, you took this loan on 1st April 2021. At the end of year number 1, there is a 1% probability that this guy, the subsidiary, may default in next 12 months. You have a loan for 3-year period, right? Now, at the end of, you have a 3-year loan, at the end of year number 1, took the loan here. At the end of year number 1, when 2 more years are to go, there is a possibility of 1% default by the ABSPL in next 12 months, which is called 12-month ECL. Right? So 1% probability of default in next 12 months. And if that default happens, the City Corp will not recover any amount, which means the entire default amount is something which this City Corp need to bear as a loss. And this probability in the second year. So we took the loan on 1st of April 2021. 1 year later, probability of default becomes 1%. And 1 year further later, in March 2023, it is given in this particular case study that this probability of default goes up from 1% to 3%. Now, in this scenario, the question is how the issuer of guarantee, which is City Corp, how would they record this transaction both at initial recognition and on these 2 dates? That would explain how the accounting for issued financial guarantee contracts within the group needs to be accounted for. This solution is given in next few slides, is something which we will look at one by one. Now, the principles of this is exactly the same as we saw last week in terms of how do you go about doing initial recognition and the subsequent measurement. We'll continue this. I'll explain this as we go along. So, we have seen initial recognition in this case will be at fair value, and this initial recognition will be on 1st of April 2021 when the loan has been taken after providing guarantee. Now, I've already given the computed number and I'll explain how this number has come. So, the fair value of the guarantee on the day the loan has been taken, that is on initial recognition, will work out to 73,320. How it is? Let us see the calculation. So, as I told you, in this case, there is an interest differential of 3%. Going by the first approach, which the ITFG mentioned. What is the interest saving? Present value of that interest saving. Now, if you have a loan of, let's say, 1 million, on which the interest otherwise would have been 11%, but for the guarantee given, the interest rate gets reduced to 8%. And therefore, on this, if the guarantee would not have been given, your annual interest outgo would have been 1,10,000. But because you have given the guarantee, now this your outflow of the interest is only 8% of 1 million. And therefore, 1,10,000 minus 80,000, the delta of this gives you the interest saving. So interest saving of 30,000 rupees per year is what your interest saving is. So in all, gross amount of interest saving over the 3 years of the tenure is 90,000. This you need to discount at the interest rate applicable to the borrower, which is 11%. So if you discount this stream of cash flows, which represent the interest differential or interest saving, with the PV factor of 11%, which is given here, then your discounted value of this cash flow stream works out to be 73,320, and that is nothing but the fair value of the financial guarantee. And this is the amount which needs to be recognized at initial recognition. So therefore, what is the journal entry you will record? The City Corp, the issuer, will record the entry at the fair value of the guarantee given, which in this case has been computed, as I just illustrated that, 73,320. And therefore, the journal entry which will be recorded by City Corp, the parent, is that they will have the liability, credit, financial guarantee, liability in the balance sheet to the extent of this, 73,320, and the corresponding debit will be to investment in subsidiary, as if they have made additional investment in the subsidiary. This reflects, the debit reflects the relationship between the two parties within the group. As I mentioned also in the previous video last week, that the debit goes to an appropriate account reflecting the relationship between the two parties within the group. And therefore, as I mentioned, this additional investment, this 73,320, this additional investment arising on initial recognition would be aggregated to the other cost of investment which the holding or the parent has, and it would be measured as per Ind AS 27, which deals with separate financial statement. Now, assume that I just wanted to highlight one of the points which was also addressed by the ITFG, in bulletin number 16. If the guarantee would have been given other way around, that means, let us say, if subsidiary would have given guarantee on behalf of the City Corp, not the parent, not the one which is our case study, then ITFG has clarified that in contrast, if the subsidiary would have given similar kind of a guarantee for the parent, then the fair value of the guarantee, which is this amount, should have been regarded as a dividend distribution by the subsidiary to the owners, that is the parent. Now, the ITFG have gone further and have clarified that a debit should not be to the profit and loss account, because it does not reflect the real nature of the relationship between the two parties in the group. So therefore, if the subsidiary would have given, the credit will still be credit to the financial guarantee obligation in the books of subsidiary then. But then the debit, instead of investment in the subsidiary, should be another appropriate equity account representing dividend distribution. That's the way the issue has been handled by ITFG in bulletin number 16. Now, that was slightly digressing from what we were talking in the case study. Coming back to the case study, given the fact pattern in this particular case study, at initial recognition, we are required to record the financial guarantee contract at 73,320, for which this is the entry which we will record. Now, the next question would be, okay, after that what? There are next 2 years. In the next immediately following year, the probability of default is 1%, which further goes up to 3%. Now we will build on this, okay, and look at how subsequent measurement will happen. Let us see this. Subsequent measurement at the end of year number 1, which is 31st of March 2022. 1st April 21 was the guarantee issued. 1 year later, the principle again remains the same. This is a familiar portion of the slide wherein in the previous video I told you that subsequent measurement, this is the paragraph reference number, this para of the standard tells you it should be higher of these two numbers, which is what we discussed in the last session as well, or in the last video. That means higher of the loss allowance, okay, and the amount which is originally recognized less any amortization which has been considered as income. I'll explain this concept by continuing the same case study. So in this case, what happens at the end of year number 1? What is the probability of default? The probability of default in this case is 1%. So if that default happens, 1% of this 10 lakhs is something, 1 million is something which is the potential loss allowance which the parent is expected to incur, which is 10,000 rupees. Now, if you look at this second one, you already had initial recognition of 73,320. So if you develop the amortization table for this financial liability with the opening balance of 73,320 by applying 11% rate, which is the what at which you discounted the original cash flows. So therefore, if you do this, it's a normal debt amortization schedule considering opening liability of 73,320. 11% of this is your interest accrual, and the benefits which will get offset, 30,000, the gross cash inflows each year. That will give you the closing balance of 51,385. What is 51,385? Opening balance plus interest accrual of 8,065, which is nothing but 11% of 73,320 minus the cash flows, gross cash flows for year number 1. Therefore, opening plus interest accrual minus benefits provided will give you the closing balance of that liability. There is an alternate way also in which we can compute it. Let's look at the alternate way. Now what happens? You initially had a 3-year financial guarantee. You are measuring it at the end of year number 1. That means you have 2 more years to go only. And therefore, same calculation which we did, 3rd year is gone. Only for the first 2 years. Same 30,000 interest saving. So if you recompute, it will give you the same answer because ultimately it's a mathematics. Right? So the balance 2 years where you have the obligation discounted at the same formula, same rate will give you the amount 51,385, which is nothing but this amount. So what you need to do, going by the subsequent measurement requirement in this paragraph of Ind AS 109 or IFRS 9, you have to measure the carrying amount of the financial liability as at this period at higher of these two amounts. Higher of 10,000 or 51,385. I have brought this number here also just to give ease of the comparison. So higher of these two numbers is what should be your carrying amount. So higher of these two numbers is nothing but what is already there in your books. Therefore, there will be no further impairment loss which needs to be recorded. You will continue with this amount because this is what you are expected to continue the carrying amount. Therefore, let me just clear this. So what happens in this case? Once this calculation is done, how do you recognize the amount in your P&L credit as the revenue during the year? We have seen in the previous video as well. So if you look at here, your opening balance of the liability was 73,320. And as per this computation, subsequent measurement tells you that your liability, which you need to carry forward, is 51,385, which we have computed it here. So the delta between these two is something you have to knock off the liability. You have to reduce the liability because you need to carry only this much. Your liability is being carried at this number. So the difference between these two, you will reduce your liability by debiting the liability, and the corresponding amount goes to P&L as the credit. And that's exactly what the entry you will record it here. So what you will do, to the extent of this 21,395, you will debit financial guarantee obligation, which you created on initial recognition. This amount is the debit. So your liability comes down to this number, 51,385. And to this extent, you recognize income in P&L as the income from, or the fee income from financial guarantee income. This is at the end of year number 1. Now, if you look at year number 2, this number has changed. 1% has become 3%. Let us see how you deal with that in the next slide. So when you come to the subsequent measurement at the end of year number 2, that is March 2023, April 21, the guarantee was issued. March 22, first year. March 23, second year. Now in this year, your same principle of the subsequent measurement. Now you have 3%. So therefore, this component, loss allowance, is not 10,000 unlike the previous slide. Now it is 30,000. Now, same thing, I brought forward the table, just that the number in the second year carrying amount is 27,038. Look at the alternative way, which we computed in the previous slide. What happens? You are at the end of year number 2. So you have only one more year to go. And therefore, in this calculation, year 2 and 3 is gone. Only for 1 year. 30,000 interest saving. Same discounting at 11%. It will give you exactly the same number which you have in this table. So there are two alternative ways by which you can calculate this number. So if you look at this calculation, your expected credit loss is 30,000, but your carrying amount in the books is lower to the extent of the carrying amount is only 27,038. Therefore, you have to carry the liability higher of these two numbers, which is this. So therefore, there is a shortfall to the extent of difference between these two numbers in the carrying amount of the liability. That shortfall you have to record now as an impairment loss. So there will be two entries, unlike in the previous slide. Now there are two journal entries you have to record, because carrying amount in the balance sheet has to be higher of these two numbers. An impairment loss of 2962. What is 2962? 30,000 minus 27,038. This you need to record. This was also deliberated by the ITFG in bulletin number 16, issue 1. They also explained and reiterated that this impairment loss need to be recorded. So what will happen now? Now if you see on the left hand side that your last carrying amount, was this much at the end of year number 1. Now what liability you need to carry go forward at the end of year number 2 is 30. So how much you can take to the revenue, to the P&L, is the difference of these two numbers. Now, the difference of these two numbers is 21,385. You will understand that this 21,385, it is after the impairment loss of 2,962. Because this 30,000 is after impairment. Right? So, including the impairment loss of 2,962, including the impairment loss of 2,962, the amount which can go into the P&L is difference of these two numbers, which is 21,385. So what are the journal entries you will record? Look at the right hand side. So the first entry you will record is the same entry or the similar entry which we recorded in the previous slide. What will happen? This is the gross amount of the income recognition. Why it's so? You have this much was your closing balance, 51,385. And now, after this calculation, gross amount is 27,038. So before the impairment, you should have recorded your income in P&L to the extent of 24,347, difference of these two numbers, and reduce correspondingly your financial guarantee. Now what will be the impact of this? Now if you look at just by recording entry number 1, your liability was 51,385 minus you reduced by 24,347. Now if you reduce these, the net amount of the liability is only this much amount, 27,038. But actually you need 30,000. So therefore, you will add and record one more entry wherein you increase your liability to the extent of impairment of 2962 and debit P&L. So therefore, this 21,385 is a net of these two entries. That means first leg of your gross fee income on the financial guarantee, and the second one is the impairment loss. Net of these two is 21,385. If you add these two numbers, it will work out the same 21,385. So therefore, if you see at the bottom, I have summarized carrying amount of the financial liability in balance sheet will be 30,000. Why? Because it will be this opening number of 51 minus you recorded this amount and then you added 2962. I've given the calculation at the bottom. And what about the P&L? P&L is this 24, which is, okay, let me clear this. P&L of 24, which is this amount, 24,347, and then you debited 2962. So therefore, the net amount of 21,385, which is what we computed here, will get credited to the P&L. That's how you do the accounting for financial guarantee if the guarantee is issued within the group. And that's exactly what I wanted to highlight and deliberate on this particular video. You have my social media contacts here. Consider subscribing the channel if you think that these videos are useful, so that you will not be missing out on any of the future videos. Thank you, and we will continue to remain engaged. I will continue to deliberate on this particular topic on other areas. What about the other sides of or the other parties? We have only looked at here the accounting related to the issuer, but what about the other two parties? Okay, this is something which we will deliberate in the subsequent part of this video, which would be most likely the concluding part 3 of the financial guarantee contract related accounting. Okay, we will see how long and the content is. Based on that, we will determine whether one more video is required or 2 more videos are required. Thank you for listening, and I hope you find this content useful. Bye for now, and I will see you in the next video very soon.